What if I told you your credit card could keep getting more expensive even if you never miss a payment? Most people think making the minimum payment is the biggest mistake. It's not. There's something happening in the US economy right now that's quietly keeping credit card interest painfully high. And if this trend continues, millions of Americans could end up paying hundreds or even thousands more than they expected. But here's the surprising part. Some people could actually benefit from it. By the end of this video, you'll know exactly who's winning, who's losing, and one simple move that could protect your money before it's too late. Let's start with one question. Have you noticed that everything feels more expensive lately? Groceries, car repairs, insurance. And if you're carrying credit card debt, your monthly interest probably isn't getting any smaller either. That's not a coincidence. Behind the scenes, one decision is affecting almost every dollar you borrow. Most people hear about it on the news, but almost nobody explains what it actually means for your wallet.
Here's what's happening. Credit card interest rates don't exist in a bubble. They're heavily influenced by the Federal Reserve's interest rate policy. When borrowing costs stay high across the economy, credit card APRs usually stay high too. So even if you keep making payments every month, a larger portion of your money can disappear into interest instead of reducing your balance. And that's exactly why so many people feel like they're running in circles.
Imagine two people. Both owe $5,000 on a credit card. One only pays the minimum every month. The other pays a little extra whenever possible. After a year, the difference isn't just a few dollars. It can become hundreds of dollars in extra interest. Same balance, same interest rate, completely different outcome. And there's another mistake that can make this even worse. Before I show you that mistake, if you're trying to make smarter money decisions instead of just working harder for your paycheck, you're in the right place. Now, here's what most people never realize. Even if the Federal Reserve eventually lowers interest rates, that doesn't always mean your credit card becomes cheaper overnight. And in the next part, I'll show you why millions of Americans unknowingly stay trapped in expensive credit card debt long after the headlines change. Here's the mistake almost nobody talks about. Many people believe that once interest rates finally come down, their credit card company will automatically lower their APR. Unfortunately, that's not always how it works. Some card issuers adjust rates slowly. Some don't reduce them by much. And if you keep carrying a balance, even a small difference in APR can quietly cost you hundreds of dollars over time. That's why waiting for rates to drop is not a strategy. Now here's where things get even more interesting. High interest rates don't affect everyone the same way. If you always pay your balance in full every month, you probably won't pay any credit card interest at all. But if you're carrying debt month after month, you're helping the bank earn more money while your own balance becomes harder to escape. The same economy, two completely different outcomes.
There's another hidden effect most people never connect. When credit card payments get bigger, people have less money left for savings, less money to invest, and less flexibility when an emergency happens. That's how small interest charges slowly turn into long-term financial stress. It doesn't happen overnight. It happens one statement at a time. So what should you actually do? The first step isn't opening a new credit card. It isn't chasing reward points. It's reducing the balance that's charging you the highest interest first. Every extra dollar you put toward that balance reduces future interest. It's one of the simplest ways to make your money work harder instead of making your debt grow faster.
But there's one final mistake that's even more expensive, and millions of Americans make it without realizing it. It's not about missing payments. It's not about spending too much. It's something that looks completely harmless, yet it can quietly keep you paying high interest for years. Here's the mistake: paying only the minimum balance. It feels safe because your account stays in good standing. But behind the scenes, most of your payment goes toward interest first, not your actual debt. That means your balance shrinks very slowly, while the bank continues earning interest month after month.
It's perfectly legal, but it's also exactly how many people stay trapped in debt for years.
So, what's the smarter approach? If paying the full balance isn't possible, don't stop at the minimum. Even paying an extra $20 or $50 each month can reduce the total interest you pay over time. It may not feel like a huge difference today, but over months or years, that small habit can save you hundreds, sometimes even thousands of dollars. The biggest lesson isn't really about credit cards. It's about understanding how money works. When interest works against you, every month becomes more expensive. When interest works for you, every month helps build your future. The people who become financially stronger aren't always the highest earners. They're usually the ones who understand this difference early. The headlines will keep changing. The Federal Reserve will make new decisions, banks will adjust rates, but one thing stays the same. The sooner you take control of high-interest debt, the more money stays in your pocket instead of someone else's. That's something no headline can do for you. If you found this helpful, you'll probably enjoy the rest of the videos on this channel because we focus on one thing: helping you make smarter money decisions without complicated financial jargon. If you learned something new today, consider subscribing. And before you use your credit card again, ask yourself one simple question. Is this purchase helping my future or making my debt more expensive? Sometimes that one question can save you far more than you realize.